Good afternoon, everyone. Good to see some familiar faces out there, some familiar names. Yeah, welcome. Welcome. I know there's going to be people coming in as we are talking here. I just wanted to get started as close to 1 o'clock as possible. So, for those who don't know me, I'm Steve Suppmeyer. I am the founder and president of Suppmeyer Technical Strategies. And I just want to be the first to welcome you to our Charted Line webinar. We will be planning on hosting these webinars weekly once we launch this service officially. Today, we're going to do a technical rundown on trends that matter. And I think that's a very important topic, especially given where we are in 2020 and 2025. But before moving on to our agenda, I just want to highlight a few housekeeping items. Please be patient. This is not Zoom. This is something called Riverside, highly recommended to us by folks that have used webinar technology. So hopefully this works really well. But it is our first webinar at Suppmeyer Technical Strategies and the first time using this technology. So we would like to run things smoothly here. So if you haven't done so already, please mute yourself. Send questions through the chat function, or you can raise your hand if you'd like to ask a question. So here's our agenda. Today, what we're going to do is we're going to tell you about Suppmeyer Technical Strategies. We're going to provide a technical rundown and show you all the trends that matter. And we're going to highlight our forthcoming subscription plans as well as pre-launch opportunities. And of course, we're going to give you the opportunity to ask questions. So what is Suppmeyer Technical Strategies? Well, it's amazing since I departed from the big bank I worked for before back in late February. There's an outpouring of folks asking me to do something, provide a newsletter or webinars and things of that nature. So I've greatly appreciated that encouragement and feedback, particularly from financial advisors, institutions, and investors when we were thinking about building our company offerings. So we took this feedback, and what we're going to do is we're going to strive to deliver financial market insights and educational resources to financial professionals, investors, and traders. The great news is we are powered by a disciplined technical research approach grounded in proven methods honed over 30 years of experience in the markets. Our goal, what we're looking to do, is provide reliable strategies and insights to support sound decision making in an ever-changing market environment. Those who follow me at the big bank know that I have a history of doing just that. To inform our strategies and insights, a little bit different than what we've done in the past. In the past, we're primarily focused on equities. Now we're going to look across asset class, equities, fixed income, currencies, commodities, and yes, even crypto, which is really exciting. We follow a diverse group of indicators, in particular trending indicators, models, seasonality, sentiment, macro, credit markets. We follow a lot. What we want to do is have a diversified approach and a well thought out approach. So what does Suppmeyer Technical Strategies offer? Newsletters, research reports published at least 3 times per week. We started publishing notes back in May, took a little time off in June, and then we started publishing back in late June. And what we're looking to do is publish newsletters and research reports at least 3 times per week, ideally 4, sometimes 5. You can expect to hear from us nearly every day on something. It's either through a research report, a newsletter, or, and I'm really excited about this, a soon-to-be launched blog. The purpose of this blog is to provide quick hits on technicals and increase subscriber engagement. This is where you can ask me a question on the stock or say, hey, you wrote about this in Charted Market Insights 3 weeks ago. What do you think of it now? I can hit that up in the blog pretty quickly. So it's going to be very interactive. This is something I wanted to do in the past, but never could. A blog. This weekly webinar, obviously we're doing one right now in early August. We're going to do another one in early September, kind of a back to school webinar. And then once we officially launch on September 15th, we will have a weekly cadence of webinars, typically running down our research views, focusing on indicators and technical setups that we are watching. We will sometimes host additional webinars as market conditions dictate, or to provide some tutorials on technical indicators. Some people had an idea. It's like, hey, you put out your research note, you give us the conclusions. Why not have a second call during the week to describe, the nuts and bolts, lift up the engine, take a look inside. It's a good idea. Again, it's collaborative. We always provide the opportunity for Q&A and client engagement. I mean, those who know me well know that I'm pretty good at that. Finally, we do provide one-on-one sessions for financial advisor and institutional clients. What we do not offer, one thing we are not is a registered investment advisor, and we do not offer personalized investment advice or manage money on behalf of clients. We may become one in the future, but as of right now, we are not an RIA. So a little bit about the team. I am Steve Supmeyer, CFA, CMT, the founder and president of Supmeyer Technical Strategies. I am the former chief equity technical strategist at B of A Merrill Lynch and have over 30 years experience in the financial markets. Since I have the CMT, which is a Chartered Market Technician designation, and the CFA, Chartered Financial Analyst, I have delved a little bit into fundamentals as well as technicals over the years. Jennifer Supmeyer, MBA. She is the Director of Operations. Jennifer is an entrepreneur with a track record of successful product and company launches. She also is an experienced marketing leader with small, mid-size, and large Fortune 500 companies. Finally, Richard Supmeyer. You may be familiar with him if you've been in the business a long time. He comes on behind the scenes as consultant emeritus. He is a retired Wall Street veteran, and you have likely seen his appearances on CNBC, Fox Business over the years, and probably more recently, at least up to a couple years ago, in Forbes. So, without further ado, let's just dive into the technical analysis meat of this conversation, and we're going to discuss our views, and we will talk about trends that matter. So I am going to dive into some of our research notes to start. So we're going to look at the chart check first. Let me just confirm with my producer, is the chart check up on the screen?
It is.
Great. So if someone joins right now, please mute your line, and we'll dive right into it. So last week we put out a note in our chart check on August 1st, and it was kind of a timely note given the big drop the market had. But the one thing we want to point out is we are big believers in market seasonality for the S&P 500. We're also big believers in the summer rally that we typically get. So you all know me very well. Most of you do anyway. And the one thing that surprised a lot of folks is, it's not sell in May and go away. It is buy in May, sell in July. Because if you sell in May and go away, you're going to miss that summer rally. Sure, I mean, the weakest 6-month period of the year is May through October. It's up. It's not as strong. It's not down. So it's not time to sell in May. We did get the summer rally into June and July. It was a very strong May through July period, 13.8% up on the S&P. I mean, that is solid. So here we are in August, and what is the important thing about August? I mean, it's if you like the Brady Bunch, August is like the Jan Brady of months. It is basically a period that separates the best part of the second best part of the year based on 3-month returns from the worst part. So August is that month that straddles contrasting seasonal patterns. So it would not surprise us one bit right here, right now, just to see some backing and filling after that 13.8% rally the S&P had from May through July. And you can see that here, June through August. I mean, August is the transition month. August through October tend to be down. It's not down by much, but you can have some doozies in there. In fact, over the years, August has become, in some regards, like the new October. Also, looking at monthly returns, you can see July, the strongest year. You kind of fade a bit in August, and then September, you typically have a rough month. Anybody who's been around long enough knows that October has its moments too. The good news about October is those moments typically lead to more upside into year end. So the bottom line is right here, right now, be a little bit defensive on the market. Maybe a little dry powder to buy a fall dip ahead of a year-end rally. That's what seasonality suggests. Presidential cycle year one, a bit magnified. You can see here, May through July, it's a 3-month period of the year, and year one most likely to be up. And we did that in a tremendous way this year. And then you can kind of struggle after that. August through October, quite weak. September it also carries over into November to some extent. So So period of seasonal weakness, you still get that year-end rally, but it's a little muted in the first year of the presidential cycle. So think about that. That's why I'm going to leave it there on the seasonality. We did provide other scenario type of work in this note, such as after a 10% rally from May through July, you can actually struggle a bit over that 3-month period of August through October. So let me just sum up the seasonality. Got the summer rally, which is what we're looking for. We think we can get some backing and filling in the fall. Plenty of support in the market. We'll get to that in a moment. And then perhaps a year-end rally. So let's move on to our charter market insights. Remember that the report I just showed you, the chart check, that's like a report that may come out, once, twice, maybe 3 times a week, depending on market conditions. The Charted Market Insights is the flagship weekly report. So what we're telling people this week, or what we told them earlier in the week, is watch supports as seasonality gets dicey. The market's been a little bit stronger to start the week, but I still think we need to pay attention to these levels as we move forward. So we're going to just quickly look at the S&P 500. This is from Tuesday morning's note. You can see here you defended 6,200 on the S&P. Additional support around 6,100. There's a gap just above 6,000. I mean, all this 200-point range is a big level to pay attention to. Right now, we defended the upper part of that. We could retest the highs, but it wouldn't surprise me to see us get a better opportunity on the long side, closer to 6,100 before the seasonal period is over. So we'll just keep an eye on that. That's what we're thinking about now. It doesn't derail our overall positive view on the market. Sure, last week we got this pattern, as you can see from the chart up on the Riverside app right now. It's a bearish engulfing pattern last week, right? And right now we're rallying against that a little bit, but it does suggest that perhaps the market's a little bit ahead of itself and may need to dip towards 6,100. We still have those seasonality scenarios for year end, 64, 65, which we got close to on the rally in July, and then 6,600. I've been on Charles Payne a couple times. We talked about those targets with him about a month or so ago. But what I want to point out is even if the market got sloppy here, watch the 26-week and the 40-week moving averages, which come in roughly around 5,900. I think those are also important. Remember, we don't go up and down in straight lines. Sometimes you do undercut a breakout point, but as long as we don't completely invalidate the move above the moving averages, we should be just fine. I did some history here. I'm not going to go crazy with these charts, but take a look at the note. You can see after you have corrective phases, you rally above the moving averages, and you may undercut them briefly, but then you get the bullish test and you just rally. Happened 2023, 2024. A few other observations here. In 2019, the last time we had a big trade war going around the world, guess what happened? We defended those moving averages and rallied. Some late stage signals in 2018. Remember Brexit? World was going to end. Well, you tested and held those moving averages. Remember Trump getting elected in 2016? People thought the world was going to end. Guess what? Market reversed off those moving averages. Same thing during the Eurozone debt crisis in 2012. And you can see in 13 and 14, these one-hit wonders that just triggered upside. When you start getting clustered signals, sometimes it could be later stage. But we don't think we're later stage because we just completed a drawdown in April and plenty of confirmation of the rally. NASDAQ 100, let's just look big picture here. That too broke out. That also has a bearish engulfing pattern during a period of weaker seasonality. 22,200 to 2,100 is support, the breakout point. The moving averages coming around 21,000, so roughly 22,000, 21,000 support there. If these areas hold, there's a definite case to be made to get towards 27,000 to 28,000 on the NASDAQ 100 over time. You got to break out there and you're above those rising moving averages. Even the NYSE looks constructive. It's a broad-based index, includes ADRs, common stocks, so it has a global component to it. Had a breakout, now it's retesting the breakout around that 20,200, 20,100 area. You can see from the chart, and by the way, these projections that we're using, just for a little education here, these are Fibonacci extensions. So you take the rally that you got from 2022 into 2024, you take that rally, project it off the correction low, and there you get your extensions. You get 61.8, which is a tactical target for the NYSE, around 21,179, and then you get a 1-for-1 ratio, which actually should really be out here, but I put it here anyway. It could happen sooner, but 2027, it wouldn't surprise us to see the NYSE at 23,800. Again, we still believe in the secular bull market. I will show you that beautiful chart a little bit later. What about the Dow 30? They stalled, but again, I wouldn't write them off. These are some big stocks, obviously. Price weighted index, so maybe that has something to do with the problems it's having. But I would say it's basically a setup that could resolve bullishly, could be a cup and handle. Again, a lot of folks, ask me if I'm looking at China patterns, wedding planning and all that. But a cup and handle is actually a legitimate technical pattern. William O'Neill from Investors This Is Daily talked about cup and handles, and it's a logical pattern. Maximum bearish in April, then you pull back a little bit, don't get quite as negative. You can see here 42,800 to 41,800 seems to be that sweet spot for the handle. If we can hold that, break through 45,000 roughly, upside, next target 46,750, and then you can get into the 53,000 area over time. So that's what the Dow Jones Industrial Average looks like. So let's get on to our sector ranks and scores. A lot of folks relied on this when we're at the big bank to help them, come up with allocations to sectors. What we're really good at is, picking out leaders and laggards and using, rules-based rankings to help inform our decision. So we're going to dive right into it really quick here. So if you look at the top 5 technical ranks, technology, industrials, comm, services, utilities, and financials. The bottom 5, healthcare, staples, energy, real estate, and materials. What is very interesting is that the top 5 and bottom 5 are generally aligned between 52-week ranks and tactical ranks, with the exception of utilities and discretionary. At this point, looking at the way the sectors shake out, there seems to be, with the exception of utilities, but again, utilities have some growth type of component to it, but it's a growth and cyclical bias, and defensives, believe it or not, are taking a back seat. I mean, look, if we have a correction, that could change a little bit on a tactical basis. But last week was a pretty big drawdown. Only utilities responded. The other defensive sectors did not. So you can see here in the table, it summarizes everything. So you got technology ranked first, both in tactical 52-week rank, and it's the only sector at this moment with maximum bullish trend scores. So I think that provides some interesting color. You can see the opposite end of the spectrum is healthcare. Eli Lilly, big drop today, probably not helping that. And in the middle of the road, you kind of have financials, discretionary, materials. But industrials has been really solid. Comm services, solid. At the moment, we'll see what happens. But I'm going to quickly go through these charts of all these groups. So you can see financials. I mean, if you look at the absolute chart, what's it telling us? It's in an uptrend. If you look at the relative chart, it's telling us that it's lost some leadership. I mean, it's not quite like a full-on bearish signal, but it is of some concern. But at this stage, keep an eye on it. I mean, if we can hold the breakout of the double bottom for this sector relative to the S&P, we're fine. The one thing that is of some concern is that the longer-term trend score, which includes the 200-week moving average, flipped negative, meaning that relative to the S&P, in order to get financials back into relative strength mode, we have to close back above the 200-week moving average. So keep an eye on this sector. It's a sector that has rolled over to some extent versus the market. Industrials are still solid. You have a new high, breakout from a bullish consolidation. The relative trend has been leadership since mid-2024. So if you look at that, we could be building a relative base. We need that as a next step for industrials. But right now, industrials are okay to be involved with. Materials, challenging. Tactical strength is fading. Relative strength to a new multi-year low. So materials is more of an underweight. Energy. A lot of people really want to buy energy for some reason. I have trouble doing that. Why? Because the absolute chart is at resistance. And secondly, the relative chart has hit new lows. It's really hard for me to want to own a sector going to new lows versus the market. Even if energy cleared this resistance, I mean, there is a risk that it continues to lag. So energy could go up 2%, the S&P could go up 5%, you're lagging the benchmark. We've got to be careful with energy here. What's a better looking group? It's technology. And it's not a late signal either. You can see from this chart showing the trend score and trend score versus the S&P that we went through a cyclical drawdown and now had a bullish flip. Looking at the history of this chart suggests that bullish flips should persist. So the next step, keep an eye on this. The next step is we want to see this relative chart go to a new high to provide confirmation of the high that we got on the index. I think it can happen, relatively speaking. Next up is our discretionary sector. Obviously, Tesla has a big impact on this. Amazon, which has struggled of late, has a big impact on this. It kind of reminds me of materials. The only difference is it's not at a multi-year relative low, but it's at a year-to-date relative low. So a little challenging here on discretionary. I would argue selectivity makes the most sense here. If you're looking at stocks on a sector basis, it's kind of middle of the road. Is there a chance that it's building a relative base? Probably. The one thing I'm watching is this trend score versus the S&P. As you can see right here, right now, it's not as negative as it was at similar levels back in 2022. Keep an eye on this. Right now, it's just not clicking on all cylinders. It's more of a, be selective, and that's where we're handling it. Comm services, quite constructive, but watch this double top. I'm not that confident in the double top unless we break below that uptrend line going back to late 2022 on the relative chart. We are so far defending this uptrend on the relative chart. There's a little bit of an uptick on its relative trend scores last week. If that holds this week, confidence increases that you could actually get renewed outperformance from communication services. So keep an eye on that too. That could be an interesting trade there. Again, in the three growthy sectors, tech looks best, followed by comm services. Among the more cyclical, it seems like industrials are a bit better than the other three. Now we're moving into defensives. The only game in town really is utilities, holding relative support, breaking out an absolute chart. But again, it's a choppy setup. It's an interesting group, but I'm not sure if I really want to be all that positive on a sector that does have defensive type of bias. But right here, right now, tactically, it's holding up really well. But again, longer term, does it make sense to be overweight utilities? Look at all the red on that long-term trend score. It's hard to get outperformance unless you're correcting 2011, 2016, 2018, 2020, 2022. So the fact that this isn't rolling into a nasty outperformance period is telling me that we're okay on the market. Staples, more challenging. Can't go to a new high, absolute. Relative chart, new low. Kind of stay away from that. Real estate, maybe base building, but it's hard to have confidence in that given new lows for the sector on a relative basis. The last one, you might want to hide your eyes here. It's pretty nasty. It's healthcare. Look at the Head and Shoulders top on the absolute chart. Look at the persistent negative trend, and their Head and Shoulders is very interesting. Green, 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 a little bit of red, brief stint in green, telling us that we're forming that right shoulder and then breaking down. Relative ratio, pretty negative since early 2023, new relative lows. So challenging setup there. Couple other items. Monthly MACD buy signals are bullish. Really all I want to highlight, I mean, it's interesting that the S&P up 85% of the time, 11% on average, roughly 11% median return, 12 months forward after a monthly MACD buy signal. Most people didn't think that. I didn't think it, but it actually is a trend confirming signal. One thing I want to point out, though, it's very interesting. We try to dot the I's, cross the T's on the analysis here. What happens when you have one of these signals in July? I mean, August starts the worst 3-month period of the year. What happens when you have a monthly MACD buy signal in the month of July? Well, look at the 3-month returns. This is August through October. Not good. Negative 2.2%, negative 3.8%. The S&P is up only 33% of the time. 3 months after a MACD buy signal in July. Sure, only a few observations. But then you look at the 12-month forward return. You're up 15.5 on average, 15 median, and the percent gain is about 83%. So I thought that was very interesting. So even with the MACD buy signal, there's a risk of following that seasonality. But based on this signal, it says dip, buy it, and 12 months forward return, pretty solid. We also did the same thing for the NASDAQ composite, which has really solid returns after monthly MACD buy signals. Real quickly here, margin debt. People love these charts. I'm going to just show a couple. Margin debt broke out, cup and handle, could go higher. This is the chart where the big takeaway is. I'm not worried about margin debt going to new highs. I'm not worried about margin debt crossing $1 trillion. I get more worried about margin debt when it peaks out and the S&P continues to rally. What is margin debt? It's like oxygen coming into the market. It's leverage. It helps fuel the rally. You can see here in March of 2000, margin debt on a monthly closing basis started to drop, and the S&P eked out a monthly closing rally into August, and then it was lights out. 2007, July peak in margin debt, October peak in S&P, lights out. April 2011 peak in margin debt. Well, didn't really happen that way. So this is one signal that didn't really work. We have to put the good with the bad. But then pretty consistent in 2018, 2019, margin debt peaked out. And then last time was 2021, October peak in margin debt, 2021, December peak in the index, lights out. So that's what we're thinking there. I am going to actually go through the rest of my commentary using Optima. Let me get into here so I can share my screen. Yep, bear with me 1 second. I think we got it. Well, there it is. You're going to see one of the most beautiful charts here and one of the most requested charts of my career. This is the Dow Jones Industrial Average going back to the 1920s. People always ask the question, where are we in the secular bull market? Well, I mean, you can see here 1950s and the 1960s. We're probably mid to late cycle in the secular bull market, 2013 the present. So middle to late stages of the bull market, it could continue. I mean, some think it can go into the late 2030s. History would suggest you can get to late 2020s, maybe even into like the 2030, 33 range, something like that. But it's a nice solid bull trend here. What else are we looking at? Charles Payne yesterday, we talked about IWM or the Russell 2000. Again, head and shoulders bottom. Russell 2000's having a rough go, actually, but I'm not going to give up on this pattern until I have to. I mean, right now we're trying to defend the 200-day moving average around 216. If you can hold 210 to 207, breakout retest once again, still would be a case to get back to those old highs. Again, when we broke out on this index, breadth was quite strong, which is why we started writing about it in May, saying, hey, right shoulder developing, look at the strong breadth. And it happened. The volume lines are going to new highs. That supports the case for this index to go to new highs. A few other things to point out. Decent breadth on the S&P 1500, decent volume advanced decline line on the S&P 1500. Broad-based indices are showing good breadth. Barrel sentiment on a buy signal. That's important. Let's keep going here. Credit markets, benign. Sure, it's a later cycle signal, but no major widening of credit spreads at this stage. Looking at high yield or the BAA to 10-year spread, still quite low. Maybe a double bottom, but it's kind of hard to get negative on a widening spread unless it widens above 2. That would be tactically challenging. If it goes above 2.5, that's when existential risk is out there. We're not near either of those levels. Across the assets, what about gold? If you look at this big gold chart, probably one of the biggest cup and handles I ever seen. Going back to 2011 that we broke out in 2024. We hit the initial count at 3360, and there is potential to get to that 4120. There could be a little triangle developing in here too. Gold tactical levels come in, around 3325, 3312, and down around 3120. If you zoom in on the daily chart here on gold, you could very well be forming a symmetrical triangle that if you were to clear this 3,430 area, you could push towards 3,800. One thing I did here is draw oversold William percent R. Why? Because they seem to be where gold found stability within its uptrend prior to going to new highs. So hopefully this works. The pattern is a bit long in the tooth, but we're going to keep an eye on it. We don't want to see gold break below the 3220s. Initial level support around the 3280s. What about silver? Bigger picture pattern on silver we're going to look at here. You did break through the 38 to 28 level, targets 45 spot 80. Again, if we draw down a little bit here and don't break below this 34 range, I think I can put a couple lines on here at the moment. Let's see if we got there. So you can see like the 34, zoom in on that one there. It's hard to kind of get it. 34.50, 34.60 range. We can hold that. That would be fine. Here's an interesting chart. It's kind of just showing XLE along with relative to the S&P along with oil. I mean, oil doesn't look very positive. It just seems to be meandering lower in a weaker trend. And the energy sector relative to the S&P seems to be supporting that. The other chart shows oil and the absolute chart energy, where the absolute chart could be vulnerable if this oil chart rolls again. A very interesting thing is we did test the trend line resistance on oil. There is risk that it goes lower. So my guess is this oil chart should stall at resistance, or the energy chart should stall at resistance. What else is going on? The S&P versus the world. A lot of folks were, I mean, there is competition, by the way, for the U.S. I mean, we highlighted ETFs for like Korea, Vietnam, a few others in recent weeks. Even China showing some signs that it's stabilizing versus the U.S. In particular, CQQQ, and the other one was GXC, which we put out in the note a couple weeks back. The one thing we highlighted was, I mean, if the dollar is weakening, there's a risk that the S&P tops out versus the rest of the world. Hasn't happened yet. In fact, it's kind of rhyming with what happened in 2018 and 2021, where the dollar broke lower, but you didn't get the U.S. breaking down versus the rest of the world. And that could be happening right here again. At this stage, what do you do with the U.S. versus the rest of the world? You either buy or hold it and put a stop below this 200 period moving average around 1.51 or so, and we'll see what happens there. The dollar index itself, I think we have that next. Oh no, we have treasury yields, but let's do that. Talk about the 30-year yield. What's going on there? I mean, people are very nervous about the 10-year yield. I mean, if it does break through 5 or 5.11, which is that high, we're getting the data from the Federal Reserve website, straight from the horse's mouth, right? Could be this rising wedge developing. I'm not sure if anybody else is talking about this. I don't have much time to see what other people are thinking, but it looks like it could be a rising wedge, meaning this should go down. You got a couple divergences here. A divergence is when your momentum indicator or any other indicator does not confirm price. So you can see the yield going to a higher high, but a lower high on momentum, and then a correction. Now I got this wedge, a couple higher highs, lower highs of momentum. There is a risk this breaks down. Maybe goes into, I mean, technically speaking, the wedge should go back to where it started, around 4% if that happens. What about the 5-year? The reason why I'm talking about these two maturities is because they have the clearest patterns. You know, the 10 years kind of stuck in the middle between the 5 and the 30. But is the 5-year forming a top? I mean, it could very well be. We shall see. You have this pretty significant divergence here on the momentum, and sometimes those do precede tops. You had one here as well back in 2018, and then a big drop in the yield. You had one coming into 2013 sideways to lower. So you can see there is a risk. If we break 3.4 here on the 5, it could go a lot lower. We're not there yet, but we're paying attention to that. The mortgage rate chart we put out a few weeks ago, we thought was interesting. I mean, I'm not sure if this head and shoulders is going to play out exactly as we thought it could, but we just wanted to flag it. If the 30-year mortgage stays below the 7.08 to 7.22 level, the shoulders are intact, and the risk is you can go below that 6.09% and maybe get a little bit lower on the mortgage rate. So we shall see. If that wedge on the 30-year bond completes the downside, one would think that the mortgage rate should drop. The U.S. dollar index, I mean, we had a brilliant call off this trend line about a month or so ago. And it did form a bullish engulfing pattern, but wow, I mean, since August began, it's just been downhill for the dollar index. This still is a valid monthly chart. The dollar, based on this monthly chart, should go higher. I mean, you can see sometimes it requires like a double bottom, but at this stage, you know, this is still a supportive chart for the dollar overall. Practically speaking, we put out this brilliant chart last week talking about head and shoulders bottom on the dollar index. Well, guess what? That's invalidated right now. You know, it looked like it was going to work really well. These, you know, employment numbers and tariff talk, you know, drove this a bit lower. So I would say that, you know, we were highlighting the dollar prior to this breakout, you know, a month or so ago. So let's just step away, take a step back, and just reassess it, because it's hit the reassessed level. I mean, quite frankly, it could reverse off that 50-day moving average, but I don't want to bet on that. The pattern that we thought it would be. The euro on a weekly chart still looks vulnerable. It still looks like it can go down. You did get that bearish engulfing last week, negative divergence on the MACD histogram. Right now, if it can't get beyond the 117.89 to 118.30 level on the euro, it probably does correct a bit. Does it need to go all the way down to that 112 handle? It remains to be seen. It did hit a major resistance, as you can see, going back many years, and this projected channel line. What about our friend Bitcoin? Bitcoin, we put out a few charts on this. It's correcting a bit, but it's holding in. It could be a bullish flag. We shall see. Shoulder, head, shoulder, upside of 148 if Bitcoin can clear this bull flag, meaning can it regain this 117,320 level? If it does, then the bull flag completes. Another look at it looks more like a cup and handle. Cup and handle, head and shoulders, very similar type of patterns. Could be this bull flag, MACD histogram improving in negative territory. Again, I mean, there's no reason to run away from Bitcoin at the moment. A lot of support, towards 110, even 107. I hope it doesn't even get anywhere near that level, but you can see that it is consolidating after a breakout, which is normal. Here's the big picture on Bitcoin. This is a logarithmic chart. The reason why we did this was because Bitcoin seems to work better on a log scale, the way it moves. You can see cup and handle 2011, 2012 hit the target, bullish triangle between 2014, 2017 hit the target, another bullish triangle 2018 to 2020 hit the target, cup and handle from 2021 into 2024. 190,000 is that target. We'll keep an eye on this bigger picture. Who knows if and when it gets there. What we're trying to do here is just say what's possible based on some charts. Ethereum, this is the one that we got really excited about. It had this measure move. It hit it around 3,600. Maybe it gets to 4,000 to 4,200 next. Seems to be stabilizing. Could find some support on a dip around 3,500 to 3,350. Here's the bigger picture pattern. Could be forming a bigger base. You can see the trend scores are improving here. And hopefully that persists. So I think I'm done with my remarks. I'm going to check with my producer to see what we're going to do next. I'm going to turn off my camera. Let's get the slides up. We're just working on slides here. Give me 1 second. We're going to talk a little bit about what we're going to be offering.
You don't have it.
I don't. I'm going to ask a question. Can people see the slide that says update on our launch? Can you do a thumbs up? Okay, they can see it. A thumbs up. Right? Thumbs up? Okay.
Okay, good. All right.
We're going to switch seats. My partner is going to go through.
Okay. All right, so welcome everyone. I'm Jennifer Suttmeyer. It's nice to meet you all. I am going to take you through a little bit about the company launch. Steve has spent a lot of time speaking with so many of you over the past few months. And what he's really done is worked hard to curate like a program that will really be best for what you're looking for. And as he alluded to earlier, he's taking kind of what he had done before at the bank, but now that he's independent, he has an opportunity to do so much more. So if you go to the next slide.
Yep.
So Steve created a package that offers a series of newsletters, webinars, and a blog. He alluded to them earlier. There is Charted Market Insights. That's the weekly report that will come out each week and be the main core report that you can refer to and really start off the week with a bang. He's also going to create a series of chart checks. These are smaller reports that go out periodically when the markets move, when there's update notes, and those come out at least once a week, sometimes more often. He's also created a report called the Stock Pulse. Again, all of these he's been putting out there for free for everyone to see. And the Stock Pulse provides a lot of different ideas on different stocks and ETFs. He's also working to launch this new blog, and this is something that we're going to offer to members. It's an opportunity for him to be more nimble and agile and get back to his subscribers really quickly. So people can send questions about individual stocks or markets, and he can respond back. And it's also an opportunity if he's working on something and he has an idea, but he doesn't want to spend the time putting it into a big report, but he wants to get the idea out to his members, he can do that really quickly. So this blog is going to also be a membership benefit. He'll also continue to have webinars similar to what we are doing today. He'll have, of course, the weekly webinar, and then if there's certain trends or topics or education, he'll also be offering webinars. So if you can go to the next slide. Okay, so one thing that we saw as we were launching this business is that when you're buying things, they're constantly asking you to upgrade and like buy things in different phases and different complicated tiers, etc. We saw this when we were working on just selecting services for this business. And so Steve got some advice from someone, and he's been really kind of using this as the guidance for this business, which is to keep it simple. And so what came out of this is that he decided to create this offering and offer one price. And there's going to be no such thing as like an upsell. You're not going to be getting, announcements about a new report and then be asked to pay more for it. The idea is that subscribers sign up. It's one price, and it's one offering of all of the services. So if you go to the next page. So in the next slide, you'll see that our core pricing is going to be $200 a month, and that includes all of the reports and the webinars. If you sign up for a year, you get a month free. So that's another incentive to sign up for a longer term period. But in addition, Steve has been so grateful for all of you who have reached out and been so supportive as he's been launching. So he really wanted to offer something to really help those of you who have stuck with him, who have supported him. And so we're calling this sort of the founding member offering. And this is something that we're going to be offering before our official launch on September 15th. And so how it will work is people can sign up to be a founding member right now, and basically they can go in and purchase the membership. You can purchase either a month-to-month, which is the $200 a month, or you can purchase for a year and get an additional discount. So that is obviously going to be the best value. And some great benefits of becoming this founding member is that you'll be able to get access to the reports and everything right now in advance of everyone else as we launch on the 15th. There's not going to be any interruption. And then, of course, as well, Steve's going to be offering some special webinars, such as a back to school webinar right after Labor Day. So if you go to the next slide, so what you can expect. So basically, beginning now, we've launched our new website. You guys should be able to see it on the web, where we have the research, we have some samples, and we have the pricing and tiers. And what's going to start happening is we're going to be offering less content complimentary, and we're going to be doing more communication about just joining. Obviously, because this is a business. We will continue to offer a free email newsletter where Steve will be providing insights and ideas, but it will be less comprehensive and more like marketing focused. So the greatest opportunity is really to sign up to become a founding member before September 15th. That way you get access to everything right now. And then if you want to wait until after the end of the summer and join on the 15th, you can just join at that point as well. And that's when you'll have access to all of the reports, the membership blog, the webinars, etc. Okay, so next slide. So the last slide is how to join. And so to join, you basically go into the new website, you select which plan that you want to choose. And then really important is to put down that your start date is September 15th. To do this, this means you are not going to be charged on your credit card until September 15th. But we will know that you are a founding member and you'll be able to get content right away. So we encourage everyone, of course, to be a founding member. But if you choose not to be a founding member, you can always sign up after September 15th as well. So thank you very much. I'm going to turn it back over to Steve, and we're going to go into the chat, and Steve is going to answer some of your questions. We saw already that some folks have asked some questions. We saw a question from Jonathan. Yep. And if you guys have any additional questions, please feel free to type them into the chat, and Steve will do his best to answer them. So thank you.
Yep, I'm back. So just to reiterate, It's yeah. I mean, essentially with the pricing, the 2000 starts on September 15th, so it'd be getting 2 months free year over year. But as of right now, as of August 15th, it's like there's another month free there, so it's like getting three free months, which is great. So let's take a quick look here. All right, the lack of participation of the energy complex, supportive of the market not being later in the cycle. It's an interesting question. I probably do need to take a deeper look into that because, because I know in past cycles like 2008 when the market was collapsing, materials and energy kept going to new absolute highs. So maybe there is something to that. I just don't know, the complete and best answer to that question at the moment. Are there any other questions here? Are we doing raised hands and things here, or what else are we doing?
One question.
Yes. Okay. So this is a new, platform that we're using, the Riverside technology platform, and I'm just trying to see if this is no, that's not what I want. Oh gosh, where is my Optima? There it is. I'm just trying to put my screen back. So far I'm not a fan of Riverside, to be honest. What do people think about the Riverside technology? It's just, will there be an app or just website access?
Website access.
Website access.
What are you trying to do, Ben?
I'm trying to find yep. Yeah, it's a little trickier. Okay, now I gotta view this. Yeah, it's a little complicated. Okay, so let's find some questions. So here's what we got here. Riverside is cumbersome. That's some feedback. Long-term S&P target. Well, I would say, depending on what we're looking at here. Well, I mean, I would say we had that count that we put on there. I mean, real long-term, it's probably 10,000 plus if you're in a secular bull market. But what we can measure at this point is what we showed earlier on the. We showed a few things here: the Fibonacci extension and the breakout around above the 6,100 level. We think even if you did back and fill towards those moving averages, it's perfectly normal to do that in a weaker seasonal period. There's potential into the 74 to 7,500 range. That's something that could be achieved. Okay, something just happened with visual effects here. Oh my God. Okay, can people see my screen still? Too many apps, Zoom, Teams. Okay, this is okay. So all right, so we're breakout candidates. Okay, well we did. Yeah, here's a few stocks that come to mind. Obviously we try to be proactive with stocks that we're thinking about and trying to do.
You need to project your screen.
I had it up there. Yeah, it's not showing anymore. Now we got Optima up there. At least I hope we do. There we are. Okay, so so what you can see here, something that's breaking out that's interesting, it's in staples, is Altria. Interestingly, it's showing improving trend scores and things like that. But I mean, just looking at this way that this stock is broken out, it does seem to make some sense, maybe for a move into the, into the low to mid 70s. Essentially, if you can hold that 60 into the 57 range on dips, even more, even more confident in that. Another one that we flagged recently on our work, we did it ahead of earnings. It was at Metastock, so META. That's a recent break, and if you look at that particular chart, there's a nice cup and handle there. It's not too far from the breakout point. I mean, plenty of upside on that, is achievable. So we do like that chart. So that's what we got there. Again, I mean, this is just breaking out here. Relative absolute good trend scores. So, I would definitely keep an eye on that. So that's what we got on that. I'm going to take a look at, is it this one? No, not that one. There's a few others. Again, more on the negative side is something like an Airbnb. I would definitely fade that. That's what we got there. CommScope did work out really well. That one we had in our chart work last week. So yeah, it was a base and then it gapped higher. So I mean that one worked, which is good. We're gonna keep putting out those ideas. And if you look at something like Abbott, we're going to pay attention to this one. I know healthcare is not a great looking sector, But Abbott Labs is building a base. Might be getting ready to work its way higher. So it's another interesting one to just keep on the radar. We're trying to find some of these next ideas. That could be one of them. Again, I mean, the stock pulse is where you find those. And we did put out a few before. So if you look at, let's see here, we had some stock pulse ideas in this tab here, which we'll just pull up on the Optima chart here. It'll take a couple seconds. So Pfizer, not so hot, but if you look at, I mean, Autodesk had a terrible print, but stock might be trying to build a base. We're trying to find things that are going to work, in the future. LHX, L3 Harris, that's breaking out here. Could go to 330, 360. Looks pretty interesting. State Street's another one, big base. Look at that Head and Shoulders bottom for State Street versus the S&P. Very different than what the XLF looks like. But this stock could go to 140, 160. Holding 100 keeps it bullish. And it looks like a good chart. We do like that one. Oh, we did put that in one of our notes recently. Cintas is another one that we got our eye on. There's a better chart in here somewhere. But Cintas cup and handle formation looks like it should be able to trend higher. Might be right there. That's the one. So you can see here Cintas, CTAS, cup handle. It looks like it could break through the 220s to head into the 270s there. So that one looks very interesting. Highlighted this. This one's gotten away from us a little bit after the breakout. This is TRMB, Trimble. Again, if you dip into the upper 70s, mid 70s, better entry. Eventually, we think it could go to 108. Bro, interesting chart. This is one that never looks good. There's this maybe a bull flag here after a Head and Shoulders bottom, trying to double bottom versus the S&P. Support around 74, 73, upside into the 100 to 105 range. Cadence is another one. That already broke out. Keep an eye, watch the dips. Anything that holds north of 330, 325, 415, 425 is possible. Those are a few names that we have there. Another one was BK. So we got that. Let me just take a quick look here. Yep, yeah, I highlighted that already. Okay, so that's what Bank of New York. Again, these were names that we have put in our notes that look pretty good. Corteva could be, a buy on a dip into the 70 to 68 range. That would be an interesting place to look at it. So let's see what else we got here. So one name that, has been a challenge, to say the least, is, well, let me just take a look at it. At least the last time I looked at it, it looked very challenging, was LULU, which is Lululemon. Again, here's a little bit of just looking at what happens to the relative chart, double top breakdown. So here's something to point out. That double top breakdown well in advance of the absolute price weakness to these new lows. So it's really hard for me to want to own this as a technical analyst. It is very difficult to see that. So that's pretty much what we got here for today. Again, it might be, if you have questions, you can always email them to us, to me. The email address is steve@suppmeyertechnicals.com. It is on all our research notes, which I'll show you in a moment, where you can find that information. So I'm going to just show you that. So here's one of our notes. So you can see here right on the right side of the note, there's my mugshot, phone number, email. So steve@suppmeyertechnicals.com. Again, I'm pretty responsive. One or two charts is pretty straightforward for me. Anything bigger than that might be a little more challenging. But again, if there's something that's really pressing that you want to ask, that's fine. I'll leave it there. We've gone on over an hour. The feedback that you've given us on Riverside, I think we may need to check out Zoom, I guess. Because that's what most people are familiar with. We just figured we'd give this website a chance here because it came recommended. So without further ado, I appreciate everybody checking us out here, dialing into the webcast. And we will have a replay. This is being recorded. So if anybody, didn't make the live call, let them know that there will be a replay, and it will be I'm not sure. Are we emailing a replay out, or is it? We'll get that information either on the website or via email. Both, probably. All right. Thank you very much for your attendance. I'm very excited about this. Again, remember, sign up, become a founding member. Again, I mean, if you sign up and put the date at September 15th and do the whole year as a founding member, it's like getting a little bit over 3 months. It's like getting 15 months there. So, so I think that would be the best bet. Thank you very much, everybody. Have a great rest of the week. Take care.